I don't know if you noticed, but Target's stock just took off following its Q3 earnings. The stock is up over 17% in just one day. And so today I wanted to find out what caused the stock to fly up so much, and is Target Corporation a good buy today? Interestingly, the company did not release a typical earnings presentation, but instead they released this infographic. So that's what we're going to use to go over their earnings report. Now, what I find interesting is they lead with some really bad news, with negative 4.9% comparable sales, negative 4.6% comparable same-store sales, and negative 6% digital sales. This means that Target is selling less goods than it was a year ago, and it's a decent bit less. I mean, that's actually kind of worrisome. But I think the big news that everybody is currently rolling with is that their GAAP earnings per share is $2.10 for the quarter, which is 36% higher than last year when they really started to experience some major inventory problems. Operating margins jumped from 3.9% a year ago to 5.2% today, and the company is saving hundreds of $millions already in their cost efficiency initiatives, and they expect those initiatives to continue to pay off. The company is also carrying 14% less inventory than they were 1 year ago, which was the main catalyst for their current issues. So it's really great to see that their inventory is dropping and dropping substantially. It's also interesting to see that the new loyalty membership, Target Circle, has over 1 million new members. And this is interesting because Target notes that members of their Target Circle loyalty program tend to take 5 more trips and spend nearly $300 more than non-Circle guests. That doesn't sound like a huge difference, but that's 1 million people spending $300 more, or $300 million in spend every single year as a result of this current loyalty program. I also like to see that Target is still trying to stay current with, new trends, their newness, as they call it, different products that they bring into their company and to their storefront that matches along with consumer trends. So we have Kendra Scott's jewelry, the Fenty beauty collection, and they're expanding into toddler foods and kitchenware through their own company brands, which have higher margins. There's also been a 12% growth in Starbucks orders at Target locations. So if you've ever been to a Target, I'm sure you've seen the little mini Starbucks inside a Target, and it's a great way to kind of combine business and bring in people who might drink their coffee and mingle and end up buying something at Target as a result of that. Target has also invested nearly $5 billion in their business this year, and a lot of that it has to do with new stores. They've opened 21 in the year, and they've renovated 150 since the beginning of 2023. You may have noticed this if your Target has been renovated, but they're kind of making the store more difficult to traverse, I guess is a good way to put it. But in doing that, it tends to lead to people buying more things just off the cuff, a lot of impulse buying, because you run into things that you normally wouldn't, because the store, again, is kind of situated in such a strange way that it's harder to navigate. So it forces you to see more products, and it ends up making the average person buy just a little bit more. So it's really good to see that the company is continuing with these remodels, and it's showing that these remodels are showing a lot of success. Moving over to this headline from Yahoo Finance about its earnings, they say that Target clobbers muted, keyword muted, earnings estimates, but student loans and higher interest rates slow sales. And to lead the article off, they say it could have been worse, and it's not like Wall Street was expecting much anyway. That's not necessarily a great thing to lead with, but that does pretty fairly sum up expectations for Target. They've had a really brutal few quarters in a row, and so Wall Street really didn't expect anything but even worse results. So to see Target starting to turn around already was a good sign. Now, in the earnings call, there was a little bit of a dichotomy where the CEO, Brian Cornell, called consumers resilient and managing to endure numerous financial headwinds and still spend money at Target. But there was also this really cautious speak all about their earnings per share guidance, which even this article here says was palpable. Cornell goes on to later say that consumers are still bringing up pressures like high interest rates, increased credit card debt, and reduced savings rate have left them with less discretionary income, forcing them to make trade-offs. Now, I don't know about you, but trade-offs doesn't really go well with resilient, in my opinion. And I would guess that this probably means that Cornell sees a lot of issues coming in the future if consumer finances do not quickly recover. The CEO even goes on to say that they see consumers delaying purchases until the last moment. And this is likely because people just don't have the money for purchasing things in advance. They're struggling to cover payments today, and they are not going to make a payment for something that they don't need until the minute they need it. So a lot of these financial numbers we'll see later, but I did want to point out that inventory, as I said, fell by 14%, but that was led by a 19% reduction in discretionary categories like apparel and home goods. And these were the things that Target was really overstocked on, so it's good to see that these items were going at a faster rate. Target does have $9.7 billion left in a prior buyback authorization, but the company did not repurchase any stock in the previous quarter. That can mean a number of things, from the company just not seeing value to the company wanting to save that money to potentially hold on to it for other things. And I do think that this is probably a case where Target would rather just hold on to its cash and not spend it on its stock, rather save it for in case they need it for a rainy day in the future. And so building on that, both the number of transactions and average check size declined in the most recent quarter. So like I said, rainy day is probably coming because people are buying less and they're coming to the store less. And because of that, Target has given a really wide range for its Q4 2023 earnings estimate of $1.90 to $2.60. Wall Street does estimate the earnings to be $2.23. So this earnings range for fourth quarter does fit with that narrative, but it is so wide. I mean, 70 cents can make a big difference on a per share basis. So this is really Target and its CEO and the rest of its head office kind of coming out and saying, hey, we really don't know where the economy is going to take us. And so I think that should give investors a little bit of pause. Before we move on to the financial numbers, can you please take a moment to like this video and subscribe to my channel? It would mean a whole ton to me. I really enjoy bringing these videos to you guys, and a simple like and subscription is a wonderful way to show me that you appreciate the content. Thank you so much for your view, and let's get into it. Revenue since 2018 has grown by over 9% per year, which is really great growth, but you can see that from 2022 through the trailing 12 months, Target's revenue has gone down. Given what the CEO said earlier, I think we can expect this number to continue to go down, at least in the near future. EBITDA has been a little more spotty, taking a major step down from 2021 to 2022 due to inventory issues, so it's really great to see that Target's EBITDA has started to come back in the trailing 12 months. Operating earnings look much the same as EBITDA, going from an excellent 2021 to a really miserable 2022, and starting to show signs of a recovery in the trailing 12 months. Gross margins have seen a bit of a decline, falling from about 30% to just under 27%. For retail companies, every percentage point counts, and so this is not a great thing to see. Operating margin has struggled as well, but it does appear to be coming back to a more normal level. And hopefully in the next quarter or two, Target is able to top a 5% operating margin once again. Return on assets also don't look great. 2021 was a bit of an anomaly, but even so, the trailing 12 months are still below 2018 to 2020 levels. Target has been good about buying back shares, and each year, on average, they buy about 3% of their outstanding shares back. As I mentioned, the company does have a lot of money set aside to do even more share buybacks, but I do not expect that to happen in any substantial number, at least for the near future. The company's cash and short-term investments have been very erratic over the last 5 years, and the trailing 12 months seem to be a bit of a normalization to prior years like 2018 and 2019. Long-term debt has increased substantially, especially over the last 3 years. But what is interesting is that Target's net interest expense hasn't changed too much, so that tells me that a lot of their new long-term debt is probably at a fairly low interest rate. Target did have a really great levered free cash flow trend before the pandemic, but since then it's been a lot more spotty, even going negative for the year of 2022 because of their inventory issues. The company is turning this number around. As we can see in the trailing 12 months, it is back above positive, and hopefully it can regain a smooth uptrend as the company had for the previous several years. Free cash flow per share looks much the same, although on a per share basis, free cash does look like it has recovered quite a bit more. Target is a dividend aristocrat, meaning it has increased its dividend payments for at least 25 years. And even with that record, in the last 5 years, they've increased their dividend by about 13.5% per year. The company generally keeps a very manageable payout ratio, and even though it did spike to 66% in 2022 due to its lower free cash flow and higher dividend, we are already seeing the payout ratio fall down to more normal levels. And hopefully it can go back to a normal 30 to 40% payout ratio in the near future. And moving over to the value chart, we can see with a fair value PE of 15, this pretty closely mirrors where Target's stock price is going to go if we follow the purple bolded lines. Now, I do want to point out that this current PE for Target at 14 does not currently take into effect the 17% increase from today. I do not get my data until the end of the week. So just as a heads up, the PE will be a decent bit higher. But with that said, the company is projected to grow at almost 14% per year. So there is plenty of growth ahead for Target. And using that growth number, we can see that a projected fair value for Target by 2024 is $131, $150 by 2025, and as high as $170 in 2026. So even though I would say that Target is not currently a great deal right now, it is a fair price, and the projected earnings growth does give you an opportunity to really take advantage of future growth in the company. And so to summarize what I like about the company, first and foremost, Target has excellent brand recognition and reputation. I, as I'm sure many other people out there, see Target as kind of being the higher end, more comfortable, more pleasant shopping experience when compared to Walmart, its nearest competitor. And so I believe that will really drive Target's growth into the future. The company is working through their previous issues very effectively. As we saw, their inventory issues have really subsided a lot. And so for at least the problems that the company can handle itself, they're doing quite well. And finally, Target is a dividend aristocrat at a near record yield. Last I checked, the company is yielding about 4% per share, which is far higher than the company usually trades for. And so if that's any indication for undervalued shares, then I think Target is a pretty decent buy right now, at least on a dividend basis. Now, what I absolutely do not like is the negative same-store sales growth. That is a huge red flag for any retail company. And while I understand the reasoning behind it and the tightening on consumer budgets, I do believe this is a major issue that we need to follow, and it does not bode well for the company's near-term future. Second, Target's recent cash flow variability has been a little suspect, and it's something that's not a complete negative, but for a company that in the past has been very stable, this variability just adds a lot more uncertainty. And finally, I'm not a huge fan at all of Target's growing debt pile and shrinking cash balance. They're kind of going the opposite directions. The one asterisk I will add here is that the company's interest expense has not gotten much larger, so the debt is probably a fairly manageable expense for the company. But it does make you wonder what Target's finances will look like in 5 or 10 years as that debt pile needs to be paid off and their cash balance is at a near-term low. So those are my thoughts on the company. As a final note, I do want to say that I do own Target, and I have been slowly adding to that position. And my investment thesis has been largely predicated on the fact that Target is a massive company, it has a great brand reputation, and it will survive this next downturn. And so I view now as a pretty decent time to buy the company when its dividend yield is quite high and it's experiencing some short-term problems. But with that said, it is a retail company, and if there is to be any more economic issues, the stock price for Target could continue to plummet. And so that is something that I took into account in my investment thesis. And I don't view that as a major issue, as I plan to hold the company for 10, 15, 20, 30, 500 years if I can. Please do not take my ownership of the company as investment advice. I do think there's a lot of uncertainty with the company's stock right now. But if you were to buy it today, I think you would at least be getting approximately a fair value. And with that, thank you so much for your view. If you have not already, please smash that like button and subscribe to my channel. I try to make these analysis videos 2 to 3 times a week, and there are plenty more stocks out there for us to analyze. So with that, I hope you have a great day, and I will see you next time.